This week marks the seventh round of the Quantitative Showdown between ChatGPT and Gemini. In this video, we'll first review the current returns and holdings of both AI simulated portfolios. Next, I'll introduce the rebalancing strategies for the upcoming week. Finally, I'll share how to apply the latest scientific research to design AI-driven quantitative investing experiments. Be sure to watch until the end. Both portfolios started with an initial capital of $1 million. This week, the S&P 500 saw a slight decline. Gemini remained roughly flat, and ChatGPT posted a modest gain. Overall, ChatGPT's cumulative return stands at 7%, while Gemini's is even higher at 9%. During the same period, the S&P 500 returned 5%. Since both models select stocks from the S&P 500 constituents, this means that ChatGPT achieved an excess return of 3%, and Gemini achieved an excess return of 4% through AI-powered stock selection. Next, let's take a look at the holdings of both accounts. ChatGPT currently holds MSFD, NVDA, HWM, PLTR, NFLX, APH, and CLAC. Among these, PLTR and Netflix have seen slight losses, while the other stocks are in profit, especially CLAC, which has been held for quite some time and is now up by 9.79%. Gemini's portfolio includes CLAC, PLTR, AVGO, LOY, MSFD, and RCL. Gemini didn't perform well this week, with CLAC, PLTR, and Eli Lilly all showing losses. In particular, Eli Lilly has dropped by 5.95%. Next, we'll see how Gemini handles these losing positions in the coming week. Our stock selection process is mainly divided into 3 steps. First, we use Python code to filter out stocks with strong fundamentals and upward trends, ultimately creating a pool of about 30 stocks. During the screening process, our guiding principle is, for trends, we select stocks that are moving upward. For fundamentals, we focus on growth, especially the increase in net profit and operating revenue. Based on these principles, ChatGPT and Gemini each generated 2 strategies. The overall approach is similar, but there are slight differences in the specific indicators chosen and how they are calculated. Here are the 24 stocks selected by ChatGPT and Gemini this week. As you can see, there's not much difference between the stocks picked by the 2 models. A closer look at these stocks shows that they are all in an upward trend and have excellent fundamentals. Next, we'll use the deep research feature of ChatGPT and Gemini to further analyze the current market sentiment and macroeconomic environment for these stocks. Next week, ChatGPT will fully sell its positions in PLTR and APH. In addition, ChatGPT will slightly reduce its holdings in CLAC, trim positions in Microsoft and NVIDIA, and by Meta. According to ChatGPT's rebalancing plan, the total allocation after these trades is only 90%, not 100%. This shows that ChatGPT isn't very good at addition. This is the second time such an error has occurred. This time, we'll simply allocate the missing 10% to cash. So after rebalancing, the account will keep 20% in cash. Palantir has been a retail favorite and a star of the 2024 AI rally, but by mid-2025, sentiment is a mix of excitement and caution. The stock soared more than 4-fold in 2024 and gained another 63% year-to-date into its May earnings, driven by AI-powered growth narratives and major government contract wins. Sentiment leading up to earnings was euphoric. Palantir was often mentioned alongside NVIDIA as an AI play. However, despite its growth, Palantir faces near-term sentiment risks and is trading at an extremely high valuation. Chat prefer Meta as a high-growth pick with more reasonable multiples. Meta is benefiting from several tailwinds: an improving ad market, new monetization channels WhatsApp, Reels, and a still reasonable valuation, forward PE around 21, which is a discount to peers, given its expected double-digit earnings growth. Our macro outlook, stable interest rates, and strong consumer spending on services also supports advertising businesses like Meta. Additionally, Meta's strong cash flow allows it to buy back shares aggressively, providing technical support for the stock. We also appreciate that Meta offers some diversification within the tech sector. It's more driven by consumer cycles and advertising, compared to NVDA's hardware or MSFT's enterprise software, so different factors influence its performance. On the other hand, Gemini made a bold move by completely selling off 3 losing stocks: CLAC, Eli Lilly, and PLTR. Next week, Gemini will add NVIDIA, HWM, and HCA to the portfolio while keeping 5% in cash. The following are the reasons provided by Gemini for selling CLAC, Eli Lilly, and PLTR. For PLTR, Gemini shares a similar view with ChatGPT. While its quantitative scores are strong and it benefits from the market's enthusiasm for AI, the sentiment score of 6.0 reflects deep concerns about its valuation, as the stock is trading at an exceptionally high forward P/E multiple of 232. As for Eli Lilly, independent sentiment analysis confirms this weakness, giving it a score of 5.5 out of 10. This is due to mixed signals. While long-term strategic news, such as the acquisition of Earth Therapeutics, is positive, it is overshadowed by negative short-term indicators. These include unusual options activity skewed toward bearish puts, a recent analyst downgrade from HSBC, and weak technicals. The stock is trading below its 200-day moving average and showing low relative strength. KLA Corporation presents a strong but slightly nuanced picture. It has a perfect trend score of 100.0 and a positive sentiment score of 8.0, supported by a steady stream of bullish news highlighting its outperformance. However, its fundamental score of 72.43 is solid, but not outstanding compared to other candidates. While the technical trend is undeniably strong, building a concentrated portfolio requires tough decisions. Given the potential for significant concentration in the semiconductor sector, it may be wise to trim this position to manage risk and reallocate funds to a stock with a more balanced profile across all three analytical pillars. From these actions, we can see that ChatGPT and Gemini share two common traits. They both dislike losses. Whenever a stock is losing money or has dropped significantly, they will decisively sell it off. Since we rebalance the portfolios every week, this approach essentially acts as a stop-loss, quickly clearing out underperforming stocks. At the same time, ChatGPT and Gemini both favor stocks that have shown strong recent gains. This may be because such stocks are getting more attention in the news and online forums, which boosts their sentiment scores. As a result, the AI tends to buy stocks that are trending upward and are popular, ensuring they don't miss out on big winners. This strategy can help the overall portfolio perform better when the market is doing well. However, looking back at our 7-week experiment, the stock market has generally been rising, so it's still unclear how these traits would play out in a declining market. If you're interested in seeing how AI performs in different market conditions, please subscribe to our channel. Using machine learning models to assist with prediction and decision-making in stock investing has long been a hot topic in both academia and on Wall Street. Before the advent of ChatGPT, stock prediction was typically studied within the framework of classification or regression. Researchers would use machine learning algorithms to identify patterns in stock prices and then predict future prices or price movements based on those patterns. However, with the emergence of models like ChatGPT, which possess powerful natural language processing capabilities, the application of AI in stock selection and decision-making has become much more flexible and widespread. After reviewing a large number of academic papers, we found that the decision-making framework presented in this particular article is both comprehensive and practical. The authors argue that successful investment decisions must take into account 4 key types of information: news sentiment, fundamental data, macroeconomic policy, and price trends. In fact, professional investors also base their decisions on these factors. Therefore, we adopted this investment framework in our own experiment. Each component requires processing a vast amount of information, and the AI model needs to collect and summarize data from each area. The aggregated information is then fed into the AI model to help it make informed decisions. In practice, we found that completing the entire workflow requires a massive amount of data, which remains a challenge for current AI models. There are thousands of stocks in the US market. Even if we limit our selection to the S&P 500, making a single investment decision still involves processing years of fundamental data for 500 stocks, months to a year of price data, news and sentiment data from the past week or two, and a large volume of complex macroeconomic data. Additionally, existing AI models cannot independently determine an investment style or direction. Whether it's value investing, high-frequency trading, or trend investing, the AI may switch between different approaches. Value investing typically involves a longer holding period, but AI still lacks the depth and breadth of analysis needed for long-term decisions. High-frequency trading is too frequent. While AI can process real-time information, Such a high trading frequency isn't suitable for retail investors and isn't very relevant for our purposes. Therefore, we chose trend investing, which focuses on stocks with upward trends and strong fundamentals. The holding period for trend investing usually ranges from a few weeks to a few months, which aligns with the mindset and practical needs of retail investors. To ensure the feasibility of the entire process, we had the AI generate algorithms for evaluating fundamental and price trend data based on trend investing principles. We then used AI-generated Python code to score all 500S and P500 stocks from both fundamental and trend perspectives, ultimately selecting about 30 stocks. For news sentiment and macroeconomic data, we directly used the deep research features of ChatGPT and Gemini. With well-designed prompts, deep research can automatically search and process relevant web content. Our financial statement and price data are currently downloaded from Yahoo Finance, which provides free data. Yahoo Finance's price data is timely and accurate, though there may be some delay in financial statement updates, usually a few days after earnings are released. In terms of cost, our main expenses are subscriptions to ChatGPT and Gemini Pro, which are $220 per month, respectively. Some viewers have asked why we don't use backtesting, since it's fast and convenient. In reality, with backtesting, both we and the AI already know which stocks performed well, so there's a risk of bias when designing algorithms. Also, the deep research feature we use can't restrict the time frame of information access, which means there's a risk of information leakage. As a result, while backtesting is simple and quick, it can't objectively evaluate the true capabilities of AI in stock investing. For these reasons, we chose to use simulated accounts to showcase and analyze AI's investment abilities. Although this approach is slower and more cumbersome, it's fairer, more objective, and the results are more credible. Simulated trading also allows us to factor in commissions and slippage, making the experiment more realistic. Our principle is to design experiments that are as close to real investing as possible and can genuinely help us with our own investments. So far, both AI models have outperformed the S&P 500. Looking ahead to the more volatile second half of 2025, we're excited to see how the AIs perform in this environment. Please subscribe to our channel to stay updated on the performance of both AI models.